Yes, good morning to our wonderful audience and welcome back to Boutiques on Wednesdays. Today is our BCI Offshore Investment Manager webinar, and it's the first of a three-part series extending over the next two Wednesdays as well. On screen now is the agenda for the day. If Dan can pop that up, we can see what we are going to follow. We've got various managers focusing predominantly on global equity, with all our managers connecting from various parts of the world. Time allowing, we will cover questions received in the Q&A bubble. After each of the presenters, we will try to cover all those questions as best possible, but you know the story, those questions we can't cover, we will circulate to the presenters and provide you with feedback. These sessions are recorded and we will post all presentations on the Boutique Manager's website as well as the recording. Right, with that said, I think we can get going. In recent weeks, the fears of recession stalked the market once again, spurred by the sharp rise in US jobless rates and with a global growth scare. However, the speed of the stock market rebound in the past few days was impressive indeed. Some global macro analysts speak of a 20 to 30% pullback on the S&P 500 yet to come, while others are of the opinion that we will not see any kind of landing whatsoever. Who is right? Should this be the case, quality and growth stocks with high cash volumes or cash on balance sheets are likely to protect better, and that will be some of the comments coming from our growth and quality managers. But we will also hear strong arguments in favor of value for the next decade. The ECB started their rate cutting cycle, with Powell now facing a mutiny on Wall Street if he does not make a September rate cut. If we listen to the likes of JP Morgan, they said 2 half-point cuts in September and November. But is this rather reflective of a deep recession brewing? Who knows? Geopolitical tensions are escalating in the Middle East with worsening developments in the Ukraine-Russia war. People sitting with their fingers on red buttons, who knows? And on top of that, the Taiwan issue is still simmering. Then we have the debate on a red or a blue win in the US and how that can potentially impact on global equity markets and various regions like emerging markets. These are just some of the topics we will cover today, with a focus on how fund managers presenting continue to find opportunities where there's growth in earnings and ultimately adding real value to your clients. It is my absolute pleasure to welcome our first presenter of the day, looking at global value all the way from London. You're all familiar with Sean Pesh from Ranmore. Good morning, Sean. How are you doing?
Eugene, good morning. It's great to be here. And after that fabulous introductory music and a coffee, I'm ready to go. So always good to see you.
Fantastic. Sean, I see your slides are on already. Just before you begin, at the beginning of 2003, you were very optimistic that value could outperform growth. And not to steal your thunder of the presentation, but your fund is first quartile ever since. But I think more so, looking at your record and Ranmore, when you founded Ranmore 2008, coming from August, you showed significant skill in giving your investors US inflation plus 8% per annum. That is very impressive indeed. And I'm sure the rest of the audience also very keen to see your views going forward and what you do in the BCI Ranmore Global Value Equity Feeder Fund. Thanks, Sean.
Wonderful. Thanks, Eugene. I mean, you raised some very interesting points, all those questions as to what's going to happen and the outlook for rates and politics and wars, etc. And we just think that the best way to protect against an uncertain future, because we don't know what's going to happen, is to not pay too much for the future. So My title of my presentation is Now the Time for Value, and I've got an old familiar chart. You'll be pleased to see that I've updated the numbers. And this is the MSCI World Value divided by MSCI World Growth. And so when the blue line is sloping up, value's outperforming. When the blue line is sloping down, value's underperforming growth. And you can see that it's been heavy going since 2007 when value underperformed growth, mainly because low interest rates, low inflation, etc. Then we had when interest rates and inflation turned following the Ukrainian invasion, we had a surge, but then the AI frenzy pulled all that back and value gave up many of its relative gains. Now, what we saw, so the question is, well, what now? Okay, we're down at the bottom here, and what we saw last month was a very, very good month for value relative to growth. And so what I thought I'd do is I just delve a little bit deeper into that. And, looking at monthly data can be a little bit misleading because as we saw with this last month, if the month ended 2 days later, different story, terrible month. If the month ended 2 days earlier, great month. So rather than just taking monthly data, what I did is I looked at 5-day rolling data, okay? And I went back as far as data available, daily data was available, which is the beginning of 1999. And in the 5 days ending the 17th of July, value was up 3.2% and growth was down 3.1%, which gave a relative performance of 6.3%. Now, you might say 5 days, that's ridiculous. Isn't that ridiculously short term? But what's quite interesting is the extent, I then looked and said, well, how many times has value outperformed growth by a monumental 6.3% over 5 days? Okay, and what it turns out, not very many. So this is, these are the little bits over here, these little points over here, where it was over 6.3%. And then I looked at, well, when were those periods? And what you notice is a few things. You notice some clusters in April 1999, April, May 2000, and then we had some, after COVID. And here are the big moves. But then what was important is then looking at the psychology behind it and saying, well, something monumental must have happened for value to beat growth by 6.3% in such a short period of time. Okay, and I think it suggests a big supply-demand imbalance. All of a sudden, people decided we've got too much growth, we want value, or we want to sell everything, but we're going to sell growth more aggressively than we want value, or hedge funds deleveraging or something. But there's a big supply-demand imbalance. So what I then did is I said, well, had you bought after those previous periods when value these supply-demand imbalances, how would you have done? Well, over the subsequent year, on average, you outperformed by 7.1%. So value outperformed by 7.1%. You can see in 1999, it underperformed, okay? And over 2 years, it outperformed in every single instance by 18.1% on average. Now, importantly, what this outperformance was largely not losing too much money. Okay, so if you actually delve a little bit deeper, value, even though it underperformed here, it didn't lose money. So then what I did is I said, okay, well, that's interesting, but let's plot those on the charts, those instances, and when did they occur? And what you can see is they occurred at turning points. And arguably, we're never going to know, but had we not had the excitement about AI, maybe this would have been different. So through all the periods, when that long period from 2007 to 21, when value underperformed growth, you had none of these big periods. You had them at turning points, okay? And so I think that's very interesting. And what it signifies to me is that everybody's on one side of the boat. If you look at everybody is long US, long passives, and the passives are long growth, and so everybody's on the one side of the boat, and you just need a few people to say, you know what, the problem is when you're on one side of the boat, you're unstable, and you don't need a big wave to shake everybody's confidence. And when you get that, people say, you know what, maybe I just need to shift a little bit. I'm not going to have all my money in one type of strategy. And so just to look at what I did is I had to look at, well, how on one side is everybody. This is Morningstar. The number of funds that are large cap growth equity is 959. The number of funds large cap value equity only 120. In other words, 90% of the funds in these two categories is in growth. And it just shows you how exposed everybody is on one side of the boat. is what I would suggest. Okay. If you look at our fund, we're very diversified. We don't have, here you can see MSCI World Index over 70%. We've got less than 20% in the World Index. We like to think we've got a more stable boat, nicely spread across places that are ignored. And interestingly, over the last month, you can see Hong Kong, some of our larger stocks like Alibaba is up over the last month. The large US tech companies are down. Fabulous companies, but everybody owns them. Okay, so now that's interesting, but is there any fundamental reason as to maybe why value should outperform? So let's look at the components of a return. So when us investors buy stocks, it's always important to not just say, well, this is a wonderful company, we pay any price. We say, well, what we've got to get for our investors is a return. How are we going to get those returns? And the returns come from three ways, really. Okay, there's an additional one I'll talk about in a sec. So you get your dividends. You're going to get your return from dividends. You're going to get a return from earnings growth. And you're going to get your return from re-rating or derating. And the fourth one is from buybacks. The reason I haven't included buybacks is that if a company buys back 5% of its shares and they don't issue new shares to staff, which is something that the technology companies in the US are not very good at, well, then you get 5% earnings growth. Okay, so I haven't put buyback in because it depends on whether shares are issued. And so let's have a look here at Microsoft now, just to put some color to that. So what we've got here, the blue line is Microsoft's share price over the last 10 years. And it's actually, June. And the purple bars is the earnings per share. Now, why has Microsoft's share price gone up? It's gone up because earnings have gone up. So us value investors, we want companies that growing earnings because, as you can see, share prices do well when earnings grow. The problem is this isn't on the right scale. You can see you've gone from 0 to 500 and 0 to 14. So let's make the right-hand scale 1/10 of the left-hand scale. Okay, and what you can see there is the earnings there, the blue line, the purple bars, and red bars, and the share price. And the share price, what you'll see, has gone up far more than the earnings. And if the share price had gone up at the same rate of the earnings, it would be about 150. And this gap is due to re-rating. And the reason is Microsoft traded at 13.5 times earnings back in June 2014, and it trades at nearly 38 times earnings now. And that increase is due to re-rating. And so if we break down that components of the return, what you're seeing is that 66% of the return of Microsoft came from re-rating. Everybody's saying this is, and now saying this is a wonderful company. And so re-rating and valuations really matter. And so what I did is I took the best calendar years for the MSCI World Index, best 5 calendar years going back since 1999. And you can see that on average, the best calendar years returned 28%. And this is where the return came from. 24% of that came from re-rating, and the starting price earnings ratio was 17 times. Okay, I took the worst 5 years, and the worst 5 years are here. These years down here, and you can see the average loss was 22%. Earnings growth only fell 5%, but re-rating was 19% of that 22. And what was the starting price earnings ratio? It wasn't 17 like the best years, it was 25. Okay, and so the point is that valuation matters. It really does matter. And don't just take my words from it. This is from JP Morgan. And what you've got over here is you've got your price earnings ratio, forward price earnings ratio for the S&P 500 and the annualized return over the next year. And you can see over 1 year, here's the, this is from their latest data book, the forward price earnings ratio of the S&P 500. And so when it's been at a forward multiple of just over 20, there've been some good years and some bad years. But over the longer period, and this is 10 years, subsequent 10-year returns, what you see is that the lower price earnings ratio multiple you pay, the higher your return. Okay, so valuations matter. And that is why, and they matter in, especially matter in uncertain times. So what is the valuation of our fund? It's 7 times earnings on a forward basis versus 19 for the world index. That was the S&P 500 you just saw the slide before. We have a price to book of 1 and 3.4 and a dividend yield of 4%. So, arguably without, and so if you look at it and say, well, how are we going to get a return? And we look at this as a overall, well, hopefully we're going to get 4% from dividends. And we obviously do lots of work to make sure we're not buying companies where the dividends are going to get cut. And if they grow earnings, well, we're only on 7 times earnings. Our starting PE is quite low. Hopefully we get some earnings growth. And if we get some earnings growth, we get a re-rating. But at least beating inflation from the get-go with the dividend yield, and it gives us some protection. If you pay a high earnings multiple for Microsoft to do what it did in the last few years is impossible. Its starting PE is 38 times. It only did what it did because it was on 13.5 times. So that's the important point. This is our performance in rands against the world index and the IA global. And so the good news here is it doesn't really matter whether growth or value are in vogue. We've managed to do well over the long term, even though value hasn't been the strategy to be. And you can see that we lagged in 2021, 22. We just buy what we think makes sense and what we think is going to give our clients an attractive return. And the index can do what the index wants to do. We're not greyhounds on a racetrack trying to catch a rabbit. And if you think that value is, you maybe want to shift a little bit more to value, well, here we've got our performance versus the value peers, and this is percentiles, it's not quartiles. And so we've managed to outperform our value peers. So because everybody is on one side, and this is a correlation matrix, you can see we have low correlation with many of the popular funds. We can't, for South African regulations, name those funds, but trust me when I say these are the large popular owned funds, and we have low correlation. So that means that if you're trying to have a stable boat, we're on the other side of the boat, and maybe there's some merit in having some of us in the mix. And we're over here in terms of value mid. So many of the companies we've got, we think they're attractive because they've been ignored by the large passives. Most of the peers are over here, growth and large, and so that's the value we offer. So no performance fees, as you'll know, sliding management fee. As we grow, we are going to reduce our fees. It's in our prospectus so that we can pass on some of the benefits to clients. We don't have any segregated mandates. So everybody is in the same pot so that we all benefit. As we grow, the other expenses fall. And as Eugene mentioned, we've generated real returns, disciplined process, diversified portfolio, and very different from other funds out there, and we think we're very well positioned. So, Eugene, that's it.
Sure, impressive indeed, and with a significant track record since inception, and definitely over the last 2 years. Question from the audience, and I'm going to take that first. You were optimistic on Japan in the last few presentations that you did. You also showed a slide now. We've got some Japan exposure at the moment, but the question then is, what is your stance on Japan after the recent fall we've seen in the Nikkei? And I think it was the biggest drop we've seen since 1989. Where are you on Japan?
Yeah, that's a very good question. So here's our Japanese weighting. In fact, it's about 9% at the moment. This is at the end of the month. We were nearly 20% when we were excited about Japan. Now, one of the things you'll know is we think clients should want turnover. Because when Japan was very much in vogue, everybody's rushing to Japan. What do you think we were doing? We were taking profits because many of those companies were close to our target price. And we were seeing more attractive opportunities in China. And so that is what we do. We move around the world based on where we think there is value. And so we took profits in Japan. And we also took profits on in many of our exporters. And so because the yen was stretched. And so we knew that when the yen then moved, the exporters would fall the most. And what was interesting, and I think there's an interesting lesson for us all here in Japan. And in fact, the other thing is in May this year, I wrote an article in CityWire warning people about how you get exposure to Japan. If you rush in and buy the ETFs, what are you getting? You're getting Toyota Motor Corporation, Honda, and a few of the large banks. You're getting those large companies. And that was what was happening. Now, so you had these concentrated bets. Everybody rushed in to get exposure to Japan via those. And what happened? They fell the most because everybody owned them. Okay, so Toyota Motor Corporation is owned by the individuals, is owned by many other companies that were now selling Toyota Motor Corporation as part of the value unlock. And it was owned by the passives. And in a crisis, what do you sell? You sell what you own. And everybody owned the same stuff. So you saw Toyota Motor Corporation fall 42%, and it's still down 30%. You saw the banks falling 35%. So that concentration and the impact in the moves, I think, is where we are. We're at risk in North America. Everybody's in the same stuff. It's the same story. Of course, Toyota's still a wonderful company, but it's down 40%. And so, we've done all right in Japan, and in fact, we've been nibbling recently. But I think there's a good lesson in the concentration risk of Japan, and I think clients should know that when stocks rally hard and hit our target prices, we sell and we move, and that's what you want. Because as a new client, you want to get exposure to fresh ideas, not some old portfolio that's been the same stocks for the last 10 years.
Sean, the clock is catching us, but I do want to take two more questions. Very quick one from Eugene Wilson. How do you manage currency exposure in the fund? Very quick answer.
Yeah, we don't hedge our currencies. Many of the companies are global companies, and so they might be listed in Japan, but they sell in the US. They might be in the US and sell in Japan, etc. So we've just got to be exposed to a basket of currencies, and you can see the basket of currencies here. Many other global funds, effectively use 70% exposure to the dollar.
I know there's a lot of or some China fans in the audience. We've seen some recovery on the H shares. You've got China exposure. Hong Kong, you specifically mentioned in the chart on the screen at the moment. But what about China A shares that hasn't rallied yet? Any exposure there?
No, we don't have exposure to the A shares. We only buy in Hong Kong, usually.
All right, fantastic. Sean, thank you so much. Still a lot
you.
more to be unpacked here. To our audience, how it works. If you want to get hold of Sean, just give us a shout and we'll get you in touch with Randmore. Sean, definitely thank you so much from our side. Your time this morning, great performance indeed, and looking to see a lot more of you and your fund in many years to come. Thank you so much.
Thank you, Eugene.
Right, for our next session, tough act to follow from value to quality investing. Andreas van der Horst from Mazi Asset Management. Andreas, you've seen that one slide from Sean on how valuations managed, but you're all about beating the MSCI while managing risk in the Mazi BCI Global Equity Feeder Fund. Thanks for your time this morning. Thank you for coming on. Looking forward to your presentation. Thanks.
Eugene and our 700 participants, thanks again for the opportunity. Sean's always a tough act to follow and a masterclass. We last spoke in May at the BCI Global Conference, and today we'll kick off with our performance figures. Then we'll briefly talk about what we do and how we do it, and then devote the rest of our time to 3 of our winning investment ideas. So let's crack on. Got the performance slide up. These are the ASISA numbers through the books to the end of June 2024. On a 1, 2, and 3 year basis, we're nicely ahead of the equity. We've delivered compelling first quartile performance, well ahead of our ASISA peer group. We've done 19.5% on 1 year, 33.2 over 2 years, and 14.6 over 3 years. Our alpha figures are 3.8%, 8.3%, and 0.3%. And these numbers are after management fees of 80 bips, no performance fees. Next slide, please. Let's pause for a moment and focus on what we want to achieve. What do we do at Mazi? What do our performance numbers stand for? We want to balance 2 central elements: deliver an above benchmark hard currency return over the medium to long term, and manage risk by avoiding the permanent loss of capital. We need to be very clear about the task at hand so that we can focus every day on our investment process. Next slide, please, Dan. How do we deliver? Thank you. How do we deliver a repeatable benchmark beating performance? We take 3 steps. We search for the best companies in the world. To be clear, not fair companies at wonderful prices or the next speculative thing. We're looking for those companies that have already won and will continue to win. When we find them, we buy these businesses at the right price. Valuation matters tremendously for exceptional long-term investment returns. And lastly, we let them compound. We're patient. Our portfolio turnover is low, very low, in fact, less than 10% a year. To quote the late Charlie Munger, the big money is not in the buying and selling, but in the waiting. Buy the best companies, buy them at the right price, let them compound. It's that simple and it's that hard. Next slide, please, Dan. On the left, we present our top 10 return contributors for the year. On the right, you'll see the top 10 return for the equity All the usual suspects are there: NVIDIA, Microsoft, Amazon, Meta, Alphabet. In the last year, how many times did you hear active managers say, we didn't own NVIDIA, or we had too much Tesla, or Apple will come right, or you've got to own the Magnificent Seven, or many other reasons for not beating the benchmark? Now, we are not trying to bash the Magnificent Seven here. It's just that the idea of having to be invested in the biggest stocks in the market in order to beat the benchmark is just not borne out by the data. For the 1 year to June, 30% of stocks beat the ACWI benchmark dollar return of 23.3%. That's 1 in 3 stocks. 900 stocks out of a 2,700 stock benchmark gave you a chance of beating the benchmark. Those are good odds. I'd take them every time. Even on a 3-year CAGR basis, the benchmark hurdle rate was only 5.7% in dollars. There, over 3 years, 29% of stocks beat the benchmark dollar return. Those are also good odds. Now, with that in mind, let's take a look at our top performers. For the most part, our top performers were not the Magnificent Seven or the weight loss drug companies Eli Lilly or Novo Nordisk. For the record, these are great businesses. We in fact own 4 of them. But outside of owning Facebook, Google, and Bookings in our top 10, I would think that the man on the street probably hasn't heard of any of our other top 10 businesses. Our quality-focused, profitable growth investment philosophy guides us to own great businesses for the long term. That means we don't have to be right on any particular investment theme or market positioning for that matter. Moreover, our approach delivers diversification. That means better returns with lower risk. Let's look at our top 3: Arista, Deckers, and Pro Medicus. Next slide, please, Dan. We've owned Arista since the launch of our fund in December 2020. This chart is the relative performance for Arista compared to its largest competitor, Cisco Systems, and then also the ACWI benchmark. Arista has delivered 380% for us, call it 5x over 3.5 years. For comparison, the benchmark did 32% nominal, and Cisco, its competitor, lagged the benchmark, delivering only a return of 18%. This is a massive divergence of returns. What is it about Arista that has made it such a wonderful investment for our clients? Next slide, Dan. Thank you. Let's start at the beginning. In 2004, Arista was established by a group of former Cisco engineers. The business listed in 2014. Today, it has a market cap of about $105 billion. At the heart of the departure was a divergence in views regarding the technology roadmap and the evolving architecture of the internet that would enable the proliferation of data centers that today makes every aspect of your and my digital lives possible. As the story is told, Arista was and remains on the right side of history. Arista's offering is accepted as the leading technology platform for hyperscale data center networking. This open standard technology was developed in collaboration with the cloud titans and uses machine learning to intelligently route network traffic to and from data centers, amongst data centers, and now also within data centers. But the best hardware in the world is not enough for these intelligent hyperscale data centers. Arista also provides the unified network software management tools that allows clients to manage their entire network, irrespective of what equipment or where on a single pane of glass. The relevance of Arista's offering has resulted in impressive growth numbers. The end market in which Arista operates is about $155 billion annually. Cisco, the lumbering giant in this story, accounts for about a third of global sales with $55 billion in sales annually. Arista only has $6 billion of annual revenue presently, but that's not the whole story. It's changing quickly. If you look at the bottom right chart, things are pretty much flatlining for Cisco. Despite $250 billion of cloud capex in the next year alone by the cloud titans, Cisco is not gaining market share. In fact, they are tragically retrenching personnel as we speak. By comparison, Arista is growing revenue at 20% per year. When we consider the profitability, this is the top right chart, Arista is quite clearly more profitable and a more productive user of capital. As Arista scales, so too does its profitability. In the most recent 12 months, ROIC, return on invested capital, has passed 32%. In the case of Cisco, things are going backwards. ROIC is now down to 17% compared to the 5-year average of 22%. For one, the sun is rising, and for the other, the sun is setting. From an investment point of view, the key challenge for us as investment professionals is to identify businesses that are profitable and growing in very large end markets, and crucially, where profitability is accelerating. Accelerating profits on a slow-growing capital base deliver an ever larger stream of excess profits. For the long term, quality investor, this is manna from heaven. One last thought on this topic. Markets reward profitable growers. This is borne out by the investment return data. Dan, next slide, please. Next up is an old friend. On a previous webinar, we spoke about Deckers Outdoor. We bought Deckers in July 22. To the end of June, give or take 2 years, we've done about 270%. Now, Nike, a former darling of the investment world, has in fact fallen 23%. Not owning Nike would have been a good thing for your clients. Over the same period, the benchmark did 39%. Next slide, please. Let's recap. What does Deckers do? Deckers owns the niche running shoe brand called Hoka and the Aussie ladies fashion boot called UGG. These two brands are growing quickly, about 20% in the most recent year. Hoka is, however, where all the action is at. Hoka, along with other niche brands, have been taking market share from Nike. This much is evident in the expected growth numbers. Take a look at the top right chart. Deckers is likely to grow revenue by about 12% next year, whereas Nike will probably fall by about 5%, a 17% divergence. Growth aside, Deckers is also highly profitable, more so than Nike. Two trends have supported the recent success and rapid growth of Deckers versus other large branded players like Nike, Adidas, and Puma. Firstly, COVID accelerated the direct-to-consumer trend. Small and niche players could grow in a very capital-light manner, whereas large established players distributing through wholesale and their own bricks and mortar stores had to fundamentally reorganize their entire supply chains and marketing organizations. Secondly, the flexibility and ubiquity of global supply chains also meant that consumers could easily access niche brands that better met their needs and expectations. In our hyper-personalized world, niche brands have become a real competitive threat to large monolithic brands. Deckers successfully capitalized on these two market developments. Now, back in early 22, when we, as investors, we were most excited when we found Deckers. Two things stood out. Firstly, our investment process was able to identify the accelerating growth of Hoka. 28% of sales in March 2022 compared to 44% of sales today. And secondly, we could buy this business at 14 times forward earnings compared to Nike at 27 times. That's the bottom right chart. At the time, this was now when we considered the investment, Deckers was already growing faster than Nike, was more profitable on a gross, operating, and net margin basis, and was earning higher returns on invested capital. When you find a high-quality, profitable, growing business like Deckers at a very attractive valuation, you do the right thing. You buy it. Great things tend to happen to rational investors. Not only then do you get the underlying business growth over time, but your investment return is compounded by the valuation uplift. 4x in 2 years is a tidy return. Next slide, Dan. Thank you. Let's look at ProMedicus, PME for short. We bought this business in 2022, end October. This is truly a unique and exceptional business. It's not in the benchmark, so most investors are unlikely to find such a company by conventional means. It's listed in Australia, does its R&D and product development in Germany, and sells its services by and large in the US. We bought the company for 55 Aussie dollars. This morning, after strong results, it's at 142 Aussie dollars. The market cap presently is about 13.7 billion Aussie dollars or 9 billion US. In the 20 months that we've owned this business, we've done about 170% in USD. The benchmark delivered 41%. Next slide, please. What's the backstory here? PME is the sole player globally and the technology leader in cloud-based radiology imaging. PME provides hardware-agnostic software that connects radiology tunnels made by Siemens, GE, Philips, and others to the cloud. It takes the examination data from CT scans, CAT scans, MRIs, and uploads it to the cloud, rapidly processes, renders it, and then distributes these inordinately complex images. Traditionally, you'll see radiology tunnels installed at hospitals with co-located proprietary computer workstations that process and render these massively complex scans. This takes a lot of time and local processing power. PME's exceptional advantage is that it dramatically improves the speed, efficacy, scale, cost, and distribution of these extraordinarily complex 2D and 3D radiology images. As an example, certain critical oncological examinations are routinely omitted by radiologists because the on-site processing and rendering of these images takes more than 4 hours. PME renders these images in high definition, ready for distribution, analysis, collaboration to any computer, tablet, or smartphone anywhere in the world in less than 6 seconds. 4 hours down to 6 seconds is quite something. This is a massive, massive productivity gain by an order of magnitude. One happy consequence here, of course, is higher tunnel utilization rate and an increasing number of prescribed examinations, and then also the increasing complexity of the types of examination. AI is also a big thing here. PME has not even begun to market its capability in AI-supported interpretation of these scans. Once deployed, this AI-led decision support capability will dramatically improve the accuracy of interpretation, lead to better diagnosis and health outcomes, and seriously drive further growth and profits for PME. In the US, PME's largest market, the company processes approximately 7% of the 600 million annual radiological examinations. That is almost 2 examinations for every man, woman, and child in the US every single year. Elsewhere in the world, the company has not really begun to market its cloud tools. Every time an image is processed, PME clips the coupon. This is an extraordinary story. Revenue and profits are growing at over 30% per year. Through the income statement, gross profit margin is 99%. The operating margin stands at 67%, and the net margin is 49%. Every single dollar of revenue turns into 49 cents of after-tax profit. It's truly astounding. Return on invested capital, despite paying out 50% of earnings as dividends, touches 50%. Years of profitable growth lie ahead. We consider ourselves most fortunate. We got in on the ground floor. Next slide, please. This morning, we've shown you some of the winning ideas that our philosophy and repeatable process generates. Now, if we follow our processes seriously, what portfolio do you get? If you attended the BCI Global Conference in May, you would have seen this slide. The table on the left presents a scatter plot of the equi. The vertical axis shows the median 5-year revenue growth rate for the equi, which is about 9%. And the horizontal axis, the median return on invested capital over the last year, which is also about 9%. The portfolio on the right is ours. Our businesses have grown 55% faster, 14% versus 9% for the benchmark. And our companies are 3 times as profitable, with a ROIC of 30% versus 9% for the benchmark. The underlying profitable compounding of our portfolio is simply better than the market. To finish off this morning's webinar, we believe our quality approach will provide long-term investors with above benchmark performance in hard currency at much lower risk. But action is what matters. The Mazi BCI Global Equity Fund is open for investment, and at 80 basis points all in, we offer compelling first quartile hard currency performance that you can stand behind with confidence. If our quality and repeatable investment process resonates with you, please get in touch. Thank you again for your time and interest.
Andreas, thank you so much for that. Insightful indeed. A couple of very quick questions. First one from Sean de Bisson. How benchmark aware are you or not in your portfolio construction, and what is your active risk? We know your benchmark is the ACWI or the MSCI All Country Index. How benchmark cognate are you?
We are not at all. We're bottom up. Our active share is 89%. And so we have a tracking error that's probably about 3 to 4%, but because we're benchmark agnostic in that sense, it really doesn't matter. We try to find the best companies in the world that are growing quickly and are deeply profitable.
And I think you've showed that in your first slide as well. If you look at your fund holdings relative to the MSCI, very different indeed. I found the one slide on Deckers particularly interesting. If you look at the growth in earnings, and we all know, if a company grows, earnings, price will follow. But interesting, next financial year, Deckers drop growth in earnings from 20% to a projected 12%. Are you concerned about things like that? And is the price sometimes not running ahead? And if you see a drop in earnings, or is those still positive? Could that have a negative impact on price?
We're long-term investors, so we're not too worried about the short term. In terms of the growth outlook for the company, our most basic yardstick is US or global GDP. So if that's about 2 or 3% and a company does 12%, then we feel pretty good about growth. All sectors and all industries go through cycles. So if something has a very high growth rate for a period of time, and there's a bit of a cyclical downswing, it affects everyone. So that doesn't concern us. The thing that we are more interested in about is on a per share basis, how much free cash is being generated sequentially, and that continues to go up. The return on invested capital for Deckers keeps on going up. So even though they're only growing 12% top line, that return on invested capital has now jumped from 28% to 35% in the last set of results. And even with 12% growth, it's going to go up more. And the company's value is a function of the PV of all those free cash flows. So that's what we want.
Yeah, and we've heard it before. If you grow earnings, then the money will come. In finding those companies is the key. I'm going to try to cover 2 questions in one, and it always speaks to the pond that you fish in. Is it only DM that you look at, developed markets, or do you look at EMs as well? And what is your view on EMs?
We look at the whole world. We don't DM EM. We look at what is the likelihood that you can beat, let's say, 10% in dollars or 9% in dollars, give or take the long term. Well, the ACWI long term is actually 8% in dollars or so, but that you can beat that by a substantial margin. And that's where we fish. Right now, for all the EM players, India is looking amazing. We haven't spent the time and effort there, but we've certainly got the diagnostic tools to see where we should be fishing. And so we continue to uncover interesting opportunities wherever they may be in the world.
Not walking around with blinkers, indeed, finding those opportunities. Andreas, thank you so much for joining us this morning. It's always insightful to have you with us. And same, we look forward to seeing a lot more of you and your fund going forward. Thank you so much.
Thank you.
Right. Continuing with a high quality fund manager, always finding higher quality returns. The asset management company, Blue Alpha Asset Management, not new to any of us. And here representing them, portfolio manager and qualitative analyst for more than a decade now at Blue Alpha, is Kyle Ricks. Good morning, Kyle. How are you?
Hi, Eugene. How are you doing?
Very well, thank you. Kyle, from our side, thank you so much for joining us this morning. Looking forward to your presentation from Blue Alpha on accessing higher quality returns.
Great, thanks, and good morning to everyone else. I think mine is going to fly a little bit closer to Andreas's, but with a very different flavor. And I think I may answer a few questions that were put to them in the process. So I guess I want to talk about how to access high quality returns. And to do this, I'm going to give you a scenario. You're being tasked with delivering a system that can consistently put forward ideas that you want to invest in, that you're comfortable with investing in, that are going to look after themselves. And to do this, I think there's a few things we want to put into place in our recipe here. These are the pillars I want us to lean on for this little exercise of ours. The businesses that we want to find have to, first and foremost, exhibit some form of value creation. And really what that is to say is that there are high enough returns that we don't have to worry that things are going to change too dramatically overnight. The world is unpredictable, it can change, but generally what we find, and there's a lot of evidence for this, if you find businesses with high enough ROICs, the ROICs, and you'll hear lots about them in my presentation, they tend to keep their face clean, they tend to look after themselves. And our jobs is to basically find the teams and operations that can do that and get out of their way. Secondly, these things have to grow. In this, it's not just my hypothetical example, but in the real world one, we are after compounding returns. And to do that with a business that isn't able to grow or doesn't have the avenues to, despite 1 or 2 years of spotty growth, you'll find yourself in trouble. So we want sustainable growth and a way to access that. And lastly, because we are trying to do this very systematically, we need quantitative evidence. We can't rely on hearsay or market rumors or any sort of aphorisms that might lead us into trouble. So we need hard evidence. And this is what I want to do today to break to you how we would try and access these systematically. Firstly, is where do we look? And I think if you want to know where you want to look, I think you first have to realize where you are in the world. The case for investing globally, unless you've externalized every single cent of your wealth, most of us here on this call today will have some exposure to South Africa, be it fixed income, be it a pension fund, be it a mortgage, be it a salary, you have SA exposure already. So when going global, the last thing I'd want to do is then offer you a global product for you then to be accessing a very similar style of returns. And when we decompose this ACWI, also a starting benchmark that we maybe look at, when we take the US out of the developed markets, the experience there mirrors South Africa's. That's unfortunate to say the least, because I don't think I need to clarify the experience of the local equity investors. But what does stand out for us? Investing in the US clearly offers a much better return dimension. And not only is it better, higher is better in this case, but it is differentiated. And I think this is the most important thing when starting and choosing a global manager, is that can they give you something that complements your portfolio already? And seeing as we're all sitting to some degree in South Africa, I wouldn't want to offer you South African returns in another EM currency. So we want to go about this process. How do we find good ideas? I'm going to ask 3 questions, or rather we're going to ask our machine 3 questions. And the first one is, does it create value? The idea of where we can find good value creation is prefaced on where we can find high and above market ROICs. There's a very interesting dynamic here, and that generally what we have seen over the last decade or 10 years ago is that the highest returns clustered around large cap managers. There's a reason people are interested in these businesses. And we've shown how this distribution of ROICs is spread out over the 25th, the median, and 75th percentile. And we've done this for 3 buckets. First bucket on the left is, you can call it your S&P 500, the 500 largest US companies. And then the next 500 and so on. That was 10 years ago. What we find as we march forward is that the biggest have gotten even better. The higher level of the ROICs for the large cap players has even improved over this period. That's remarkable. That would lead to an understandable re-rating, because the nature of the businesses is not what they were 10 years ago. For the next group of 500, it's a bit good, a bit bad, a messy mix, but the median stays largely the same. I'm not going to spend too much time on it. It can be quite an emotive subject, but the smaller cap, it's actually gotten worse. They're sort of dwindling away at the margins, possibly being eaten out by large businesses. So this is what we see, and this is where we want to be looking. We want to be looking in large cap, want to be looking in the US, want to be looking at ROICs that can grow and improve. So we've got this undercurrent of quality. That's the first step. The idea that we can stay invested in these businesses is prefaced on one particular dynamic, and it's quite a powerful one. We want to be lucky. I don't think anyone would agree with that or disagree with that. The idea of how we can stay invested is prefaced on this. What we have done is shown a distribution or transition matrix, give it its full name, of where you would find, what percentage you would be in the higher bracket of ROICs had you chosen a different starting point of ROICs. And that's to say, what percentage does your stock stay in the top bucket of ROICs 10 years later? That 51% implies that if you were to choose a stock at random and it had top quartile ROICs, 10 years later, more than half the time, it still has the top quartile ROICs. We can extend that and say, choosing the top quartile, if you had to buy it and leave it, there's almost 80% chance you still have a high quality business 10 years later. These things don't change. High quality businesses are persistent, and this is a persistent nature of what we're trying to follow. Unfortunately, there's another side of the coin, and that means if you choose a low quality business, almost 80% of the time, if you were to revisit that business 10 years later, you will find it still in the lowest bracket. This does highlight one idea, and this is another area we don't tend to focus on. This matrix kind of implies that corporate turnarounds are very rare, and they actually are. It's fantastic and very intellectually satisfying to choose something at the absolute lows and watch it fix itself and take you to glory. That's not where we want to play. We want to play where we can get lucky, and we can get lucky 4 out of 5 times by just staying in the high ROICs. We need these things to grow. This is the second question. We can't simply have high returns, but the companies find no further avenues for growth. Management might find themselves getting itchy fingers and start to buy something, or they could ultimately wind down the business. Either way, we need these businesses to grow. So I've decided to put together something just to demonstrate what I mean by this growth. And it is going to be, I will say I've taken some poetic license here with regards to the figures, but please humor me. I've got company A and company B. They're both saying the same thing in their management calls, that they are investing 10% extra every year. They're growing at 10%, and these things may seem like quite exciting prospects. There's some underlying dynamics that separate them. Company A just earns a higher ROIC. It's probably rated a bit higher. Meanwhile, company R with a low company B has got a much lower one, and it actually may have a lower rating, and you could get quite excited about it. It's growing just as fast as company A. It's rated a bit lower. Yes, it's got lower returns now, but there's possibility for it in the future. What we've learned from our previous transition matrix is that these dynamics don't tend to change very often. And so what we find is that as they currently stand, growth is helping company A. It's fantastic. Growth is hurting company B. They are holding an ice cube next to a fire, and it's getting ever smaller. This is wealth destruction, and it happens more often than you think in companies that both may seem like they're growing. So what to think about this is that ultimately you want to be first looking at quality before you even consider the growth aspect. This step is important. Why we think about them in this order is because quality and growth need each other. These are like teenagers in some romance novel, desperately longing for one another. And I think about it in this sense. Another transition matrix, I promise it's almost the last one. It is, how do we think about where there's an intersection of growth and quality, and where does this start to make sense? What we find here, and this is average annual excess return over the S&P for in excess of 20 years. The best return comes where you have high growth with high quality. And so we want to make sure we can first prove out high predictable quality before we go looking for growth, because growth is ultimately a nice thing to observe, enjoyable thing to target, but it can change. So let's first focus on the predictable before we look at what we could have. This is another version of this. What's our percentage chance of outperforming? Again, that top right proves something to us. If we focus on high quality and high return, we're actually guaranteed to outperform quite often and by a quite fair amount, as is the experience. So here's a little nugget for you to take away. You can only target growth when you already have a high ROIC. Ultimately, this bears the question, and it's important given the other panelists on this call, how much to pay? And this is the third question, quite an important one. It's no secret. If you have to target the businesses that we do, you will be paying more than the average stock index, and that's fine. So I'm here to give you 3 rules to be reasonable, and they're quite easy to implement. If you see free cash flows less than 2, forget about it. PE is more than 30, 2 years out, not a chance. And enterprise value over sales that exceeds 10 times, it's a non-starter. To just speak about some ideas that will actually make sense here, Microsoft very much skirts this last one very often. And so that's why it wouldn't necessarily fall into this process. So when we had these 3 ideas of how we kick out ideas, we find that 20% of the stocks that have made it so far in our process, once they reach this valuation, admittedly very wide and very conservative valuation metrics, 20% of them are just going to fall out. We're not going to focus on them. I will be the first to put my hand up and say, I think for the more value focused managers in the audience, these numbers are probably not even something you're even dreaming about looking at, but we find that following quality first and then growth, this is ultimately the space we have to contend with. So these are our hard lines, our line in the sand, regardless of market or season. How do we do? I think this is important. We've tried to find a systematic way of always bringing good ideas to the table. It does so with high persistence. And if we follow 2 out of my 3 questions, we do fairly okay. We do quite well to find quality companies that create value as well as grow, and they outperform an already tough benchmark to beat, S&P 500. When we take out that extra 20% that is just unreasonable in terms of valuation, we do exceptionally well. This is a powerful metric, and when we compile all these 3, we find a great way to access a high quality of return in a repeatable and predictable fashion. So this is, I think, something I want to highlight, because when I did all this work, I immediately thought, okay, this system has really just picked up tech companies and it's run with it, and they've enjoyed a fantastic 10 years. So obviously this is just a tech screen. That's not the case. When we do a decomposition about where these returns have come from, and this is a nice big table, so I'm only going to highlight 2 numbers, they're in blue. The information technology weight in this approach was actually smaller than the market. There was no undue massive tech bet happening here. Similarly, the tech companies it chose actually slightly dragged on performance, so it could even do better if we had to add a qualitative overlay. Ultimately, this is not a result of just high tech, but high quality consumer names are actually where the value is. And this is what we want to leave you with, is these 4 rules for developing your own idea and how you go about solving for this problem that we find. 3,000 stocks in the MSCI ACWI. How do you find good ideas? These are the rules. Always invest in high return on capital. Growth only works if the internal returns are high enough. Otherwise, we are melting away our capital at a rate. And we will have to get comfortable with the idea that you will be paying a premium, that there are some hard rules, and avoid the unreasonable. And the most important part, the secret sauce to this recipe, is you have to follow these steps in order. If we find ourselves trying to find cheap companies first, we will not necessarily be, almost definitely I can guarantee you will not be finding the highest return on capital businesses in the subsequent step. So I think this is all from me. I would like to ask if there are any people interested in following this cookbook for accessing higher quality returns.
That's a very good thing indeed. And like I said in the introduction, I think we're all familiar with Blue Alpha. You made your investment process very clear around this time again, understanding why it actually works. Your process declines well for decades now already at the intersection of quality and growth. A very quick question, nothing from the audience at this stage. But we've seen so many times how finding or identifying the right company with good earnings growth. You also mentioned, at the right price. That matrix was very interesting indeed. But when you find that and it does happen sometimes when you buy a company, and it doesn't necessarily work out the way you thought it would, how do you avoid capitulating on a company? And when or how do you decide to actually downweight companies or shares like that in the portfolio, and when do you do it? How do you do that?
Ultimately, there is some level of a fundamental story we're following. This is, the screen is a cheeky way to try and summarize it in 10 minutes, maybe a bit more. But it is fundamental work goes into it, and we're always intact with when this returns break. Any business that exhibits any sort of quality or high ROICs will have some level of stability within its segments in between it. When these change, they tend to break things quite big, and they tend to break quite loud. I think we can look at, it's a global conference, but I'd almost hesitate to speak about MTN. We understood how its contribution from its different segments with different geographies was quite stable over time. When that changed, that was the end of the story for us for a while. Management teams will find themselves taking quite a while to fix these issues. So for us, it's the level of the ROICs, and it's which segments are contributing to it. When that changes, the stories change. We tend to follow a fair bit of the price action. We're not trying to actively down weight things that are doing poorly. Unfortunately, the market does that for you. We'd rather spend our time making sure we've got the right ideas, looking in the right pond, than over trading, because ultimately you've got to make two decisions correctly, and you've got to sell correctly and then rebuy correctly. We like to remain lucky by just picking the right pond, staying with them as long as we can, and we do obviously monitor these things quite closely.
Thank you so much for your time this morning. And like I mentioned, you study our investors well for decades now, a very clearly defined recipe that works well, and I'm sure will continue to work well. Thank you so much for your time this morning. Always great to have you with us. Blue Alpha BCI Global Equity Fund. They've got a couple of other mandates as well. If you want to get in touch, let us know, and we can get you in touch with Carl and his team. Carl, thank you. We'll chat to you again in the near future.
Cheers. Thanks, Eugene.
Good stuff. Right, moving on to global credit. We all know global credit is highly uncorrelated to most vanilla asset classes that you will find in typical global portfolios. And there's a compelling argument to hold as diversifier as part of a global carve-out of your client, regardless of the mandate. In SA, we've recently seen a contraction in credit spreads relative to nominals, but can this be said of global credit, or more specifically European credit? No stranger to the audience, joining us all the way from London, from Fairtree, Paul Crawford. Good morning, Paul. Thank you so much for coming online again. It's always great to have you join these sessions and sharing your insights on global credit and what you're doing in the Fairtree Global Income Plus Fund.
Thank you very much, Eugene, and good morning to everyone on this call from a rather balmy London. I mean, I don't know if anyone's aware, but it was literally 32 degrees yesterday. So we've had a pretty decent summer, all sort of 4 days of it. But anyway, so yes, thank you for the introduction, Eugene. I'm going to be talking about the BCI Fairtree Global Flexible Income Plus Feeder Fund today. I've got 20 minutes, so I'm going to have to delve right in and get through this. I'm basically going to be talking about 4 things today, and 4 things only. And that's firstly, what the hell is the BCI Fairtree Global Flexible Income Feeder Fund? That's to start off. What is it? What are we trying to achieve? The next thing I'm actually going to contextualize is how it's actually done. Now, this is incredibly important. I mean, how we investors actually choose unit trusts from the plethora of those available is quite a daunting task for any investor. And it's always sort of good to just sort of take a step backwards and have a look at what we can expect over the long run. There's nothing simulated here. These are real. All the numbers are post fees that I'm going to show you. So it's real. The next thing, and I think probably one of the most important things I'm going to talk about, is what this fund isn't. Now, that's a very strange thing to be talking about. But essentially, I know there's a lot of sort of banter about, global credit valuations and whether spreads are too tight, whether they're going higher, whether there's going to be defaults. So we're going to talk a little bit about that. So what it isn't, almost like describing it what it is and then describing it what it isn't. That'll go quite a long way in helping investors sort of know how to sort of package or pigeonhole this fund. And then obviously I'm going to finish with conclusions. I've basically got 20 minutes. So what is it? It'll take about 5 minutes. How it's done, about 5 minutes. What it isn't, about 5 minutes. So it should be okay. Okay, so what is the BCI Fairtree Global Income Plus Feeder Fund? Well, it was actually in response to what clients want, paradoxically. So we've had quite a long track record of managing sort of onshore and offshore credit funds for the BCI Income Plus Fund, and specifically mentioning one. And that strategy is, as you know, has sort of paid off rather handsomely over the long term. So this was in response to clients that wanted an offshore BCI income plus fund. So we launched a euro-denominated Fairtrade Global Income Plus Fund, which was predominantly only for euro hard currency-based investors. So how could ZAR-based investors invest in this fund? Well, we had to launch a feeder fund, which feeds directly into that global credit fund. So again, it's using your offshore limitation to just get access to global credit without having to come through the BCI Income Plus Fund, which is a mix of both domestic as well as offshore credits. So the fund itself was launched in April 2019, and it's got over a 5-year track record now. So it's been going for some time. Yeah, remember the BCI Income Plus Fund had its 10-year anniversary this year. That's been running for over 10 years. We've got 10 years of track record. But this fund has been launched just over 5 years ago. And the beauty of it, again, is for those that are sort of set up on specific platforms, you can access this global fund using rands, and it pays off in rands. And you can invest and divest using your rand-based accounts. You don't need to go and set up a euro-based account with whoever it might be, Barclays or Bank of America or Deutsche Bank or whoever. So that's what it is. That's what it is. Yeah. So that's what the aim is. Yeah. So what I'm going to show you is essentially, yeah, that's what it is. Let's have a look at how it's sort of done. But here's a typical sort of feeder structure. I'm not going to go through it. It's quite a busy slide. Basically, the rand investor puts his money into the feeder fund. The feeder fund then invests in the euro base. It changes the rand to euros, buys the euro global income, flexible income plus fund, and then those performance of those units in euros is translated back to rands, and you get your performance out. That's what that's basically saying. So what does it consist of? Well, again, it's a feeder fund. So 94% of it is actually in the Global Flexible Income Plus Fund, the Euro Fund. And then the rands, we have a little bit of rands to cater for ins and outflows for liquidity. So we park our cash in the BCI money market fund, so we don't get too much cash drag. And then a little bit just for 0.3% of the fund. That's just for daily flows, which funds daily outflows. That's what that's for. So that's what it currently looks like. So we need to delve a bit deeper into what the Global Income Plus Fund is. So it's a euro-denominated Irish domiciled UCITS fund. That was launched in January 2019. It's got an ITRAX crossover benchmark, which I'm going to show you a little bit later. It is predominantly a euro-based credit fund, but it certainly has UK and US dollar-based assets in it as well. It's what we call a spread capture fund. So just like the BCI Income Plus, which aims for JIBOR plus a spread, the Global Flexible Income Plus looks for Euribor plus a spread. Euribor is the 3-month euro equivalent of JIBOR. So just like in the BCI Income Plus, within the Global Income Plus, all FX risk, so that's US dollar to euro and pound to euro, all that FX risk is hedged back to euros, and it takes no duration risk. We can talk about that a little later if there's any questions about whether we, about the duration bet and how that's gone of late and stuff like that. What does it invest in? Well, if you have a look, it's invest in corporate bonds, government bonds even, South African government bonds. It's got 81 bank instruments in it, funnily enough, and that's obviously euro and pound denominated. And it's got index-linked notes in it as well, which follow the benchmark itself. It's got 39 instruments with 350 different obligors. So in other words, there's 350 underlying names. So this is a well-diversified credit fund. Its concentration risk is out there, the UCITS 5-10-40 rule, which is a lot more stringent than what we're used to in South Africa, being the BN90, Table 1. Everyone's pretty well au fait with that. And I just want to state this, okay? Like our other unit trusts and every single fund that we manage within Fairtrade, we don't side pocket, okay? So if we have any defaults, which when you run credit funds, of course you have defaults, it's part and parcel of what you do. We've never side pocketed and never needed to. So when you look at the performance of the fund and that which is published every week that you see in the Glacier numbers or whoever's publishing it, that performance history is real. It's not, let's get rid of all our bad sort of eggs and put them somewhere else. So the performance numbers are real. So let's have a look how it's done, right? So to start off with, to show you how it's done, it's always good to contextualize things again. So what I've got here is I've got the top 40 index, the ALLBE total return index, and STEFI, the cash index, which are indexed to 100 back at the end of September 2006. And this is to the 31st of July. So it's monthly numbers, and it's the most recent we've got. So if you invested 100 Rand back in the end of September and you invested in the top 40, the equity top 40 total return index, which is inclusive of reinvested dividends, you'd have 632 Rands and 25 cents at the end of July. That's what your total return is, 632%. Well, yeah, excess return, 532 sort of thing. You've made 532 Rands profit on your 100 Rand initially invested. The ALLBE total return fund, your 100 Rand turned into 439 Rands, almost 440 Rands. So you've literally got 340% return. And if you'd invested in cash, your 100 Rands would have turned into 333 Rands and 66 cents. So yeah, decent sort of returns. So we can actually back out risk premium from this. So that is just risk premium is defined as the difference between the index and cash. So that's excess return to cash. And I've annualized these numbers. So the equity risk premium backed out since 2006 to 2024, 18 years worth of data, is 3.65% per annum on the top 40. Term premium, which is the ALLBE, which is got term assets in it, it's not cash. That term premium is only 1.56%. So you would have generated 1.56% per annum above cash by investing in the All Bond Index. That's what that means. And this is what the long-term one can sort of expect. Through the long term, somewhere between sort of 3.5% and 4.5% in equities, and bonds somewhere between 1.5% and 2.5%. That's sort of what you should expect. Please don't expect massive returns because of short-term performance. We're not investing for the short term, we're investing for the long term. So let's have a look quickly at how the credit indices have done. So we're going to have a look at the iTraxx crossover index, also indexed to September 2006 to date. I chose that date because that's when the total return index was promulgated. In euros, if you'd invested 100 euros in the iTraxx crossover index, you would have received 263 euros. If you'd invested in euro cash, you would have 120 euros. So paradoxically, 18 years of cash investments in Europe, you would have had 20% total return over 18 years. Shocking. But anyway, from these, we can back out credit risk premium. And the credit risk premium is 4.5% per annum in euros, backed out of the differential between iTraxx crossover total return index and a cash index in Europe. When we relate these back to Rands, because you are Rand-based investors, your 100 Rands would have actually generated 525 Rands and 76 cents, basically. If you had taken that 100 Rands and invested it in a European cash index, you'd have 239 Rands. So when we relate this to STEFI, we see that Euro cash underperformed Rand cash coming through the FX translation of 1.84% per annum, which you can actually state then that the FX risk premium is minus 1.84% to euros. So in other words, for a Rand-based and for someone in Europe investing in Rands, he would have generated an extra 1.8% per annum if he'd just invested in the STEFI rather than his euro-denominated cash index. So the credit risk premium over this period in Rands is 2.59%. Just remember that number. If we show all in one graph, we can see that the top performing of all of them is equities, which is no surprise. The second best, the orange one, is the credit risk premium. That's European credit, which generated about 2.6% per annum. And then bonds produced about 1.56% per annum for that period. So that contextualizes long-run performance, not short-run performance, long-run performance. If we look at this in sort of return and risk, we get this. The interesting part is the bottom one, and that is the correlation matrix. So iTraxx crossover ITRX TX5I is negatively correlated to the All Bond Index and has got low correlation to the top 40. So it mixes well. So what has the fund delivered? Well, the fund was launched in April 2019. And since that time, we have produced fund risk premium, i.e. excess return over STEFI of 2.6% per annum. The term premium over that time, some 5 years, has produced 2.34%. You know that bonds have had a great run over the past 12 months. And then the equity risk premium over that time, 4.2%. So again, contextualizing things, putting things together. And there is the mean and standard deviations of the returns, as well as the correlations. Again, you can see the feeder fund has got no correlation to the All Bond Index, and it's got low correlation, extremely low correlation to the top 40. In fact, much lower correlation than what the All Bond Index has got to the top 40 index. So let's talk about what it isn't, right? So I'm actually going to debunk commonly held, unsubstantiated myths about credit funds. This is what some investors say, is that credit is too risky. And then they cite this concept, which is, oh, with credit, you can have a permanent loss of capital. This is an interesting concept, that you have a permanent loss of capital. Well, what I'm showing you here is the BCI Income Plus Fund unit price. Over 10 years worth of data. You see this sawtooth effect going on. That's because of, this is the unit price itself, and the sawtooth effect is thanks to quarterly distributions. So it's sawtooths, it rises and it pays out, rises, pays out. But the interesting part of it is that it started at 100, and it's currently, as of the end of July 2024, 122. Now remember, all interest is distributed, including offshore interest. So where does the extra 22.68 come from? Well, believe it or not, that's capital gain. So this concept of you can have a permanent loss of capital, the exact opposite has happened in the BCI Income Plus Fund. We've had capital appreciation over the last 10 years. So that debunks that. I could show you the same for the BCI Fairtree Global Feeder Fund as well, which shows increase rather than decrease in capital from 100 to 156.8. Now is not the time to invest in credit. Defaults are on the increase. Well, they're not. Yeah, this is the history of iTraxx crossover, and it shows you the number of defaults in that index since the very first series way back in 2004. That's number of defaults. The red ones are the ones which are still alive. That's the number of defaults in 75 names that make up the indices. So yeah, they're not an increase. That's nonsense. High interest rates mean high defaults. What I've got is I've got ex post 3-month Euribor total return for the next 5 years, coupled with iTraxx crossover losses. And what I actually show you here is that 5-year returns of Euribor on the x-axis versus losses on the y-axis. When I put a line through it, there is no correlation. There's no linkage at all between high rates and credit losses. It doesn't happen. And then the last point I want to make is that defaults are unexpected and they arrive like a thief in the night. This is what people think. Well, here's what I mean by what I've just said. So things are going all well, and then boom, a default occurs. And then your asset, which is worth 100, then literally goes to zero, 5.5% par. This is what people fundamentally believe, is that, you know, credit does this. So everything's fine, and then boom, it defaults. It does happen sometimes, but certainly not in European credit. Because currently we do have a default in the iTraxx crossover series 40, and it's ATOS. Now this is sort of, the orange line shows you the price of the bond that ATOS has issued, a bond that ATOS has issued. And that's percentage of par, which shows you that the mark-to-market process in global credit works really well. So by the time the default actually occurs, which was on the 24th of July, the price was already down to almost negligible price, down at 5.5%. So the market well anticipates defaults. They don't come like thieves in the night. They are well discounted. So that debunks that myth as well. So to conclude, what does the fund do? Well, it allows you, a RAND-based investor, access to the global credit risk premium. And that's, the long run is about risk premium, not really about sort of stock picking, certainly not a credit perspective. From a credit perspective, so the fund itself has delivered STEFI plus 2.6% over the last sort of 5 years. The credit risk premium is real. Yeah, it's not imagined, and it's uncorrelated with local assets. I've showed you that. Permanent loss of capital has not been witnessed in any of our suite, and we certainly haven't side pocketed to hide losses of capital. Defaults as yet globally have not shown any signs of increase. They will at some stage, I can say that. But it will be well discounted well in advance. There will be no surprises, I just want to say that. The default experience is not correlated, I've showed that. It's not correlated at all with short-term interest rates. And remember, short-term interest rates are coming down now. They're not going up, coming down. So if there is any correlation, well, then you'd expect defaults to come down, but it's already over a low base, very difficult to come down from zero. And then to finish off, defaults are expected. They're expected to happen. They're well priced in. ATOS is a great case in point. It's well expected and well discounted. So there's no surprises. So people ask me, what about defaults? Well, you know, by the time the default occurs, it's all in the price. It has no effect on funds. So yeah, but how many defaults? It's like, yeah, that paradoxically, it doesn't really matter, because when you have well diversified, you diversify away idiosyncratic risk, which is driven to zero, which means when defaults occur, it's so small you don't even see them. And this is exactly what you've witnessed. The income plus unit price even tells you that. And that concludes my presentation for today.
Paul, thank you so much indeed. It's a pity this is not a live session, because I'm sure you would have seen from the audience a couple of nods and smiles and even a giggle or two in between. Other than being a credit expert, you're always very entertaining and calling a spade a spade. Right. Paul, just one question from you, nothing open from the audience. You touched on it briefly. The globe expecting rate cuts, the Fed possibly in September. I'm not going to say they're going to cut. I don't know, but let's see. But it makes bonds or nominal bonds or TIPS very topical at the moment. A lot of people fleeing into bonds, duration-based assets, hoping for those first rate cuts and seeing the gains coming through in bonds. My only question to you, credit served us extremely well over the past, 15 years. You've showed it in your returns. Going forward, why sell credit and not bonds?
Well, let's start talking about what's priced into the market. I mean, it's like, that's what really counts. So currently the South African market has priced in about 150 basis points worth of cuts. You know, so that will take repo down from 825 to, you know, sort of 675, around about there, 150 basis points worth of cuts. Yeah. That's fully priced in at the moment. You know, so if you're expecting more than 150 basis points worth of cuts, yeah, buy bonds. That wouldn't be a bad idea, you know, but effectively, diminishing margin returns and all these sorts of things. But let's just say you think there's going to be 250 basis points worth of cuts, which I certainly don't. But let's just say you do. That will take JIBOR down to sort of 575. The governor, I just want to say this, the governor gave us a lot of information in his last post-MPC speech. He said that equilibrium repo is 2.8% real. Now, what does that mean? Now, if you consider that we're an inflation targeting regime in South Africa, where we're targeting CPI between 3 and 6, that's got a midpoint of 4.5. So that tells me adding 2.8% to 4.5 gives me 7.3%. So equilibrium repo is 7.3%. And it will move maybe 100 basis points each side. So at 6.3 to 8.3 where we are right now. So, at 675, the maximum you can expect more from bonds themselves is an extra 50 basis points from where we are right now. What is that in total return? Well, it's a capital gain of an extra sort of 2.75%, and then a yield of sort of 8. So you are going to generate, if you expect that, you are going to generate double-digit returns. Yeah. In the meantime, you're going to have obviously quite some volatility, which arguably everybody's witnessed. With a credit fund, yeah, your returns will reduce because remember, JIBOR decreases. This is a JIBOR plus spread. So you're going to add sort of 2.8% to where JIBOR is. So at the bottom, I would say this fund will deliver maybe 9%. At the top, it's going to deliver 11 to 11.5%, I would say. So that's the range that you could expect from the fund. But no doubt about it, Eugene. I mean, I can't argue with what bonds have delivered over the past year.
Yeah.
The bond index has delivered 18.1% in the last 12 months. It's a phenomenal story. Very few fund managers have outperformed that 18.1%, but that's what it's delivered. What it delivers going forward, that's debatable. It certainly isn't going to do another over the next 12 months.
Exactly, it's in the numbers.
We're
running slightly over time, but I think the question from Sean very important. I want to take this very quickly. Are you pricing in that the MPC targets a new inflation of 3 instead of 2, which has been discussed? And what is the probability of this happening in your views?
Look, if we target 3, there won't be rate cuts, eh?
Yeah.
So, I mean, at the end of the day, to strangle, that's a bad term, but to deliver 3% on inflation is, I'm not just talking about once off, but I'm talking about an equilibrium inflation number of 3. We've struggled actually reaching an equilibrium inflation number of 4.5. So we're staying within the band. So I think it's a difficult thing to get to. But if we are going to target that, trust me, there won't be rate cuts, because we've got to change people's sort of long-term expectations on inflation.
Yeah.
Which is like inflation won't be tolerated, therefore 3% is enough. I think that's going to be very difficult, and to do so will require much more stringent rates, or higher rates, more than the 2.8% real.
Higher rates,
much higher real rates.
Yeah.
So
exactly.
arguably, I mean, one more thing. Arguably, if we've got a reduction in the inflation target, the governor will have no reason to cut interest rates until we get down to 3% and sustainably make that. At 5.1, arguably, we're not even at 4.5. So arguably, we're not even at midpoint yet. Yeah, it's so all these sort of beliefs that we're going to do 300 points of cuts, that's just not going to happen. I'm not saying it's impossible. If we have another COVID-19 story, of course that will happen, but it just can't happen. Say that under normal conditions.
JP Morgan views perhaps very, very aggressive or too aggressive. Paul, thank you very much. It's been really great to have you with us again. Looking forward to seeing you soon in SA. Hopefully, it's always great to have you on any of your sessions. The BCI Fairtree Global Income Plus Fund, I mean, Paul explained the fund exactly what it does. Highly uncorrelated to a lot of asset classes. It's still a very good place for credit in portfolios. Paul, thank you so much. Fantastic. And we
Thank
are
you
going
very
to
much.
move on. We'll chat to you again in the near future. Right, moving along very quickly. Going into emerging markets and having a look at emerging markets, it surely offers a lot of value. We all know that valuation is very attractive. It doesn't feel very comfortable if we look at the past couple of years with US and developed market dominating performance industries for the past 15 years. But here, representing GQG Partners is a well-established US-based asset management firm managing in excess of 150 billion US dollars. And here to give us a bit more insight on the views of the emerging market, joining us now is Charles Bester. He's normally based in London, but he is visiting South Africa and at the moment in Bloemfontein, spot on in the middle of South Africa. Charles, good morning. Thank you so much for coming online. Charles will be joined by his colleague, David Jenkins, who is based in Brisbane, Australia. The time there now is just before 7, so early evening there. David, thank you so much for joining us as well. Really looking forward to giving us an update on emerging markets and your views from a GQG perspective. Great to have you with us. Charles, you're going to share a little bit more about the company and how Southern Right Capital ties into GQG as the representative of the firm in South Africa. And then we're going to look at your EM fund. Thank you, Charles.
Thank you. Good morning, Eugene, and thank you to BCI for hosting Southern Right Capital and GQG Partners. So Southern Right Capital is an investment advisory firm. In South Africa, our aim is to offer investors exposure to highly talented investment managers through our range of fundraising partnerships. So we currently act as the manager of 2 rand-denominated feeder funds, the Southern Right Capital GQG Global Equity and the Southern Right Capital GQG Emerging Market Equity Fund. Both these funds feed into their respective master funds managed by GQG Partners. We're also very happy to offer South African investors access to Indian equity through our partnership with the ASK Indian Entrepreneur Fund. Southern Right Capital continue to invest in our team and resources, and our current global footprint includes Europe, the UK, South Africa, Australia, New Zealand, and the Middle East. We are very happy with the returns achieved by both these strategies, with excellent I'm sure every investor in the fund will be happy looking at the slides and the excess returns that we've achieved. Today, as you mentioned, I'm very happy to introduce David Jenkins, Client Portfolio Manager of GQG Partners, all the way from Brisbane, Australia. David has kindly offered to answer any questions about recent volatility or any specific names in the portfolio, but please refrain from referring to the rugby. If you have any questions, please don't hesitate to contact us at clientservices@southernrightcapital.com. Thank you very much, and over to you, David.
I hate to admit that was something I did request from Charles that I agreed I would do tonight, as long as he didn't mention the rugby. So I feel like you've partly broken that agreement, but that's okay. We can carry on. I was actually there as well, Charles, and it was devastating. But I'll jump right into it. I'll just make sure my screen is being shared correctly before I do. I'll just triple check that is working. Here we go. Okay.
Yeah, David coming through. Perfect. Absolutely perfect. Thank you.
Thank you. After all these years, I think we've still all got to check that things are working correctly, but here we are. So look, GQG Partners, as per the introduction, we now manage $155 billion US, which is been gathered only over just 8 years. So thanks to Charles and some of the partnerships we have globally, it's been a really successful period in terms of both growing the business and you can see here that we have 4 main strategies globally. We have US equities, global, emerging markets, and international. And obviously, Charles represents our global and emerging markets fund. Now, the reason why I wanted to show this chart in particular is because when we talk about emerging markets, it's as an investor that covers both global and emerging markets. So when we talk about the bullish view that we have on EM and the opportunity set that's available, it's in the context of having the entire market available to us. It's our view that's truly understanding both areas of the market, both developed and emerging markets, gives us a competitive advantage across both strategies, as it can truly understand the end consumer, and you can uncover opportunities across both markets. So when I say that we're bullish on EM markets, it's not a one-eyed view. Time is definitely now for EM. Within our global and international investment strategies, we can go up to 20 to 25% in terms of EM exposure. And right now, both are over 10% in terms of their exposure. Now, here is the team, and I'll dial it back a little bit because I understand there's a group of investors that may not be as familiar with GQG as Charles and I am, and then maybe some other people on the call. But GQG stands for Global Quality Growth. Now, I did listen to a presentation earlier that spoke about quality growth and how they intertwine. We have our own unique view on quality, being that it's forward-looking and it changes over time. And I think the recent volatility in technology markets is a great example of that. Trying to pick a winner and picking forward-looking quality at the moment, particularly in that sector, is something that's challenging and something that's definitely going to continue to change. So put simply, we're looking for companies with improving quality attributes. And when we talk about growth, we're talking about compounding capital over time. And we're looking for improving or sustainable earnings growth. So the team that's been operating now for 8 years was a new team purposely built, looking for a perspective advantage. So we cover large mega cap stocks, both in DM and EM. They're the most covered stocks in the world. So we have the view that you're not going to get an information advantage by talking to CEOs or reading reports more than anyone else. We believe the truest way to get an alpha advantage is through perspective advantage. So the team is all generalists, purposely built with different backgrounds, and we have a unique mix of both traditional and non-traditional analysts, which isn't quite as common across the investment universe. To give you an example, my friend Mike Concrite in the top row there with the bow tie, he's an example of one of our domain specialists and a non-traditional analyst. He's a former researcher who keeps us up to date on stage 2, stage 3 testing on big pharma. But the other type of non-traditional analyst we have in the group is a collection of ex-investigative journalists. Again, feeding into that idea of getting a perspective advantage, the ex-journalists look into non-traditional data points, ex-employees, regulators, all feeding into our sort of overall view to get that broader perspective advantage. Now, amongst the group there is a broad set, just diversification-wise, looking at the group. In age, background, gender, even languages spoken across the team. We cover 17 different languages. I haven't tested it personally, but I'm pretty confident it's correct. And all those things tie together when we look to have a devil's advocate approach to picking stocks, all those perspective advantage and things from every direction. Now, Charles covered our performance. It is on this slide as well. You can see both across our emerging markets and our global equities products on a 1, 3, and 5-year basis. And since inception, we've far exceeded our goal of performing by more than 2 or 3% over a full market cycle. But the reason I wanted to show this chart is it's a good demonstration of how active we are as a manager. And you can see that through the sector exposure chart over time. So while we underwrite companies for 3 to 5 years, we have a strong sell discipline. So if something breaks in that 3 to 5 year period, we're very comfortable moving on from an idea and adjusting to what we see in terms of a better risk-adjusted opportunity. So we're bottom up, fundamentally stock pickers with that unique view on quality, that unique view on growth, and we act on appropriate data points. So a little bit different to the presentation we heard a little while ago where someone will stick and ride through the volatility. We're very comfortable if the market's proving us wrong or if the data points change, moving away from an investment, coming back, checking the data point, and then coming in and buying it again at a higher or lower price, but once we've got that conviction. Because what we're looking to do is hit a dual objective, which is to protect client capital and also participate in market upside. So that's also demonstrated. You can see in the upside downside capture numbers on the bottom left. Now, emerging markets is often seen as a volatile investment environment, but we have managed to navigate that where we've got less than 70% downside in terms of the market when it goes down, and we participate in most of the fundamental upside. And that's what I mean by compounding capital over time. We're happy to miss sometimes on the upswing as long as we don't get hammered on the down. And this is the last slide I'll share on us before I jump into some emerging market views and probably pile through so I can get to some questions on current market volatility. There's been definitely a lot of activity across our portfolios in the last 3 or 4 weeks. You can see here, this is our demonstration of alpha and beta over time. So when I say we're always looking for the best risk-adjusted opportunity, this is the proof point. We've been consistently top quartile alpha and consistently bottom quartile beta. And that's not something we're targeting through certain types of stocks or from moving to cash. That's purely from our bottom-up stock selection and moving to that best risk-adjusted opportunity over time. Okay, so for those of you who have potentially seen GQG present previously, this is a slide that we think really captures the missed opportunity in terms of emerging markets and just how much growth there's been and how much growth there is. If you have a look at the chart on the left, it shows the MSCI proportion of emerging markets in the index, which has shrunk over the last 15 years. And in contrast, the GDP growth across emerging markets has gone up and is emerging or touching on closer to what was 50% of total world GDP. Now, I think it's pretty unlikely I'm going to get any audience buy-in given the crowd and the amount that's here. But oftentimes I like to ask if anyone actually knows what the top 5 countries are in terms of global GDP, and to not pause and wait for no one to answer. We've got US, China, Germany, Japan, and India as the top 5 in terms of GDP globally. So 2 of the world's largest contributors, GDP-wise, are from EM nations. You go give it 2 years, India's going to be up to number 3. India's already number 4 by market cap. And as we roll down the list, 5 of the top 12 in terms of GDP are EM countries. So EM continues to grow. It's increased from 13 trillion in 2016 to 21 trillion in 2023. It's going to be greater than the US economy by 2030. It's an outstanding opportunity set that people either aren't investing in enough or are missing the nuances of how to invest. And what I mean by that is if you look at DM markets, about 80% of GDP is reflected in terms of indexes where you can invest. In EM, it's about 60%. As a sort of stark example, energy in China in terms of GDP is 15%, but it's only 2.5% of the Chinese index. So there's a real difference in terms of finding the GDP drivers in particular countries and finding ways to tap into them versus just doing an index allocation, which won't get you that reflection, won't give you that proper driver into the market. Now, it's topical, I guess, that we heard from the last speaker speaking about interest rates. I think this year, on top of inflation, interest rates, AI, politics is probably the only other large big ticket item of 2024 that's been consistent around the traps. One point I want to make here is that politics creates volatility across all markets. And if you then look at what the policy implications have been in developed markets is they're going backwards in terms of positive changes for markets. So in France, you've got the New Popular Front. If you look through their policies, they're looking at increasing high minimum wages, increasing super profit taxes. Now, these things aren't great for markets. In the UK, markets reacted positively, but should they have? Whereas India and Mexico are two very different stories in terms of EM. Mexico is sort of bucking the trend for pro-business policies in EM, whereas India continues to be a shining light. Now, I'll explain what I mean by those two things. And this is probably where looking through the noise in terms of media and broader markets is important. So if you look at the two headlines here, in the UK, biggest win of all time, when the Conservatives got 18% of the vote, crushing defeat. Whereas if you look at India with the exact same margin, Modi being the winning side of his coin and the opposition getting 18, it was a great defeat for Modi being on the winning side. So it's a rather amusing twist of interpretation that's showcased by these headlines. And that's where it's important to read through the headlines and trust the fundamentals when you're looking at opportunities, both in markets and underlying companies. We've got a real competitive advantage there. Charles can potentially talk you through it individually if you're curious about how we walked in and out of Adani as an investment opportunity. Plenty of investment media noise still happening there, but the fundamentals are really, really strong. Now, I'll show you here in two images how you can see that quite demonstratively. In the UK, these are the forward-looking budgets, all taxes, not much spending, not a lot to get excited about from a market's perspective. And this is pretty consistent with what's happening in a few European places versus EM markets where there's price liberalization, tax incentives, and privatization. You know, it's much more swinging in terms of pro-business for EM markets than it is for a lot of DM markets. And our poster child for that is definitely India. India and Brazil, Indonesia, they've been very pro in terms of infrastructure spending, good government privatization decisions. And they're very decoupled in terms of results from DM markets. In the past, I think there's been an association that anything that happens in DM, EM immediately feels a shock. But if you think about it this way, India at the moment is building 40 kilometers of new road every day. Cement companies in India aren't going to be impacted by a potential slowdown by the US consumer or tariffs between US and China. There's a lot of internal growth there that's going to be completely uncorrelated to what's happening across in US markets. EM to EM trades growing, the infrastructure spend's easy to tap into, which applies to things like utilities, energy requirements, industrials, import capacities, even banks with increased commercial lendings. There's a lot of internal growth within these countries, which is completely independent to things that are happening in some of the developed markets, and allows you to either through a global fund that accesses these types of investments or a bespoke or dedicated EM allocation, get quite an uncorrelated return profile to what you might be seeing across other developed markets. Now, I heard the comment as I started the presentation in terms of the cheapness of valuations. And that definitely is the case across a number of particular stocks in different areas in EM. But where we get excited about EM is more about the growth that we're seeing. Now, the cheapness of some stocks is a bonus. And obviously, you want to buy things at a reasonable price. But if we take China and India over the long term, India is more expensive on a relative sense, which is what this chart is showing compared to India. So the median price differential, it always has generally been more expensive versus what's currently India is higher priced. That's because growth hasn't come back in China, and growth in India is going through the roof. So if you look at the relative return in India versus China, there's a reason some of those valuations are higher. So we're comfortable sometimes paying a high valuation if we're seeing that sustained earnings growth. And one of the things you'll also find, and we have this through a few holdings as well, is that if you dig a little deeper through the index in India, you can find comparably lower valuations for stocks that are growing quite well and are included in indexes. As long as you're tapping into the GDP drivers and some of the idiosyncratic things that you're seeing through those markets. This is another example I like to throw out. I think it really speaks to the shift in nearshoring, which is just another concept that's come through markets in the last couple of years. You can see the huge uptick in terms of India trading things to the US. Now, I don't know how I'm tracking for time, but this is a portion in terms of relative opportunity set. So when we're constructing our portfolios, one team, they put all the stocks together and then they'll put them down through the relevant strategy in terms of the available opportunity set. So they'll go through the entire world and they'll go, these are our best US stocks, these are our best EM, this is our best global with some EM, and this is our best international, and international is global ex-US plus EM. So when we're considering an investment opportunity, again, it's always about the best relative opportunity set that's available within the strategy structure that we have. Something we've been getting a lot of questions about, and to be honest, it has dialed down in the last couple of weeks, is why aren't you in Japan? Now, our view in Japan is that the relative opportunity set across different countries has been far more compelling. And when we look at Asia, just as an example, you can see that in both India and Taiwan, that the relative growth and opportunity set has been better in those places versus someone like Japan. Now, easy to say that today, but as Charles will know, I had this signed off by our internal compliance people about a month ago. So I can confirm that this was our view prior to obviously the issues that we've seen in terms of the carry trade in recent weeks. Now, this is probably the trickiest slide I have if in terms of reading. But what it's trying to say here is very much paramount to how we think about investing, and that is that earnings are like gravity. So the tough thing with EM markets in particular is that return profile of the market index itself hasn't been great over the last 3 years. We've managed to navigate that by tapping into the true GDP drivers. But if we look at the market in general, the trend you can see in this graph, if you focus on just the yellow bar, is that the change in earnings is what's been driving the overall return in EM markets. Now, it was good 15 or so years ago. It's been poor over the last 10. And then if you look at the last few years, you can see those bars in terms of earnings growth really turning around. So it's our view that markets are driven by earnings, and you can see now that those are going in the right direction. And you can find a way to black out the noise, tap into the most relevant GDP drivers. There's a diversified income stream to DM with income drivers is available. So the things I wanted to make sure I was clear on today, and please ask me to go across any of the particular slides that weren't covered in enough detail or clarity. GKG Partners, we're a very successful scaled boutique investment manager with one team, one process that covers both developed and emerging markets. It's our belief, and you can see it through the stats, that emerging markets are larger and more relevant than ever before. And we're starting to see sustained and not developed market dependent earnings from these markets. As long as you look through political noise, media noise, there's opportunity present in all markets. If you follow the data, you'll find opportunities, as long as you're willing to continue to follow and change those data points over time. So look, I'll stop there and see if there's any questions from the crowd.
David, thank you very much for that indeed. Two very quick questions, very insightful indeed. The growth really exciting in emerging markets. Just very briefly, your views on China. You're obviously very excited about India. Do you access any opportunities in China directly, or do you get some sort of exposure to some of the recovery taking place in China, or are you just totally out of China?
Yeah, so our Chinese position over the last 3 years, we've been very much underweight. So if you think of the index, and I'll talk in terms of our emerging markets fund, if you take the index at say 26%, we've hovered between 3 and 10% in China over that 3-year period. Over the last 3 or 4 months, we've probably become incrementally less negative about China. A lot of the bad news is baked in. But when we look as a high concentration manager, in terms of that earnings visibility, it's tough to go into China with confidence in a number of sectors. So where we have been invested is things like PetroChina that tie into the energy independent story that China's moving towards, some of the mining companies there as well. But more broadly, the way that the CCP introduced this concept of golden shares over the last few years, where they have people sitting on boards and directing company direction on public companies. They really are just all state-owned enterprises that aren't really sort of directing their own fate. So for us, if the CCP is on board or it's in line with sort of common prosperity, we're comfortable with a few Chinese companies, but more broadly, we just think we can get better earnings visibility somewhere else. And when we talk about EM markets and our positive view on it, generally it's China and the rest of EM. China really seems to be a strategic market and has been for quite a while.
Interesting indeed. Just to get a sense of your allocation to emerging markets, when your EM fund is a pure EM fund, you also run a global equity fund amongst other mandates for the feeder funds through Southern Right Capital. We've got the global equity mandate as well, also growth mandate. What is your EM exposure in your global equity fund?
At the moment, it's between 10 and 15%. So what I would also say to that too, when we think again about that relative opportunity, so the best relative opportunity upward of maybe 2 months ago has been in terms of US technology companies. So that's where our larger overweights have been. You can see that in terms of our allocations here, that dark green line, the top left sector allocation chart. Whereas in some of our international strategy, which doesn't have access to those US tech companies, it's been heavier overweight to EM for the last few years. Where we've had some allocations has been to some areas of India and Brazil are the largest 2 allocations. Some of those are backed by tailwinds in those economies, and some of them are more idiosyncratic views. Say a company like Petrobras in Brazil, which operates at sort of 2-3 times in terms of its PE ratio, and then has been delivering sort of a 30-40% dividend for the last few years. It's quite a unique beast. They have the same sort of free cash flow of a Shell or even an Exxon, but trades much lower due to the perceived political risk there.
Very interesting and insightful indeed. David, thank you so much for dialing into our session this morning. We're really grateful for your time, and it was great to have you get exposure to the SA audience as well. There's a couple of open questions from the audience. Charles, I will circulate that through to you. Things like geographical exposure as well specifically, but we'll answer that offline and we'll send that through to the audience. Charles, thank you for your time as well. Really appreciate it, and we'll chat to you soon. Thank you very much. Right, we need to move on very quickly. The clock really caught me, but I want to give Nick Dennis from Anchor Capital, he's full-time. So Nick, I'm not going to cut you short. And saving the best for last, I mean, Anchor Capital has been around for a very, very long time, successful asset management business running several mandates, including global equity, which you will focus on and share your most recent views. Is AI in a bubble, or is it a bubble? Some of the things you will be discussing as well. Nick, thank you so much for joining us this morning, and apologies for keeping you a little bit later. But like I said, you've got your full-time slot, and thank you for coming online.
Right, thank you, Eugene, and good morning, everyone. And so I've chosen quite a controversial topic, but it should be interesting, if nothing else. So I'm addressing whether, in my opinion, AI is in a bubble or not. And I'm viewing it as I'm addressing this topic as a fund manager. I'm not a data scientist. I'm not a computing engineer. I'm a fund manager, so I view it through that lens. So I want to quote George Soros, who is one of the greatest traders and speculators of all time, and he had a somewhat unusual take on bubbles. And so he said, when I see a bubble forming, I rush in to buy, adding fuel to the fire. That is not irrational. So that's a bit of a different take, and that keep that at the back of your mind as we go through the presentation. So my guess is that, and I've asked audiences before, how many of them have used an AI tool like a ChatGPT? And so typically the answer, it ranges, it's about, I would say, 50% of people, so roughly half. So to give an illustration of what this craze is about, and one of the use cases of AI, I've given a relevant example. So I went into a tool called Perplexity, which I actually prefer to ChatGPT. And I put in the prompt. I said, okay, I'm giving a presentation on whether AI is in a bubble or not to an audience of investors, and give me a few points debating both sides of the argument. So Perplexity came up with a bull case, an argument that AI is in a bubble. You can go to the next slide, and it gave me a couple of points. I'm not going to go through them here. And then it gave me, it gave me a couple of other points saying that, arguing that AI is not, in fact, in a bubble. So you can see that AI is it's like an outsourced assistant. It's you adding intelligence to your process. And so why would you get excited? Is you think, well, imagine I take my manpower and I can multiply it by twofold or threefold or tenfold. I can get 10 times the amount of intelligence. And imagine if we do that on a global scale. It's very, very interesting and potentially incredibly powerful. So it's real, and more than just being real, it's potentially very, very useful. And it's still early days. I'll give you another example, which is also very accessible to everyone. So we've got these ChatGPT and Perplexity and these other large language models, and they generate things in text. But we're also getting to the point where generative AI can generate also pictures and video content. So if you go into WhatsApp and then you look for a Meta AI chat, you can literally type in anything in there, and it can generate pictures for you. So I thought it would be relevant for this morning's webinar. I said, okay, I want an image of financial advisors in South Africa watching a webinar about artificial intelligence. And this was the image it came up with. And you can restate this in all kinds of different ways. But it's the image isn't perfect, but it's pretty good. And so you could just start to think of the applications for a range of professions and different use cases. Well, what this could be potentially used for. So let's talk about really the 800-pound gorilla, and that's NVIDIA. And I've just put the pronunciation at the top there, and that's how you say it. There's people kind of get the pronunciation a bit wrong, but it's called NVIDIA. So chips. NVIDIA is essentially a chip company, and when we think of chips, chips go in everything. They go in. You find them in your phone. You can find them in your TV. There's chips in your car. Give me chips in your fridge. There's chips all over the place. NVIDIA's GPUs, and this is an image of their next generation platform, which is coming after the current generation, and it's called Blackwell. These are essentially big chips, These are not things that fit in the palm of your hands. And then you've got these chips that are very big and they fit together in data centers, and there's cabling and there's switches, and they are big chunky things. And what you see there in the image of what you would see in a data center. So what makes NVIDIA so special? And I think of it as an innovation moat. You can go to the next slide. So people say that NVIDIA's chips are very, very expensive, and they absolutely are. The H100, the Hopper series, they're very, very expensive in terms of a dollar unit price. And then they say, well, there's some competitors that they are, maybe a cheaper on a per unit basis. But I think the difference is between an NVIDIA and a peer like, say, AMD, is like comparing a Ferrari with a horse-drawn cart. And the images on the right-hand side both come from Meta AI, literally generated them in WhatsApp. And so, yes, a Ferrari is way more expensive than a horse-drawn cart. But if you wanted to do if you wanted to race around a track, or if you wanted to get from 0 to 100, in the least amount of time, you're gonna a horse-drawn cart is a complete non-starter. You have to go for the Ferrari. So they outperform the competitors in terms of sheer performance. And so on a value for money basis, and performance per dollar, NVIDIA's chips stack up well relative to competitors. So they've got this performance element. I also think so they take a fundamentally different approach to how they build products. So I think of it as a Lego approach. So they work out, okay, what is the end goal in terms of what we need to produce for these large language models, and they put all the pieces together, all the GPUs, the cabling, everything else, and then they optimize that, and then we say, okay, this is like our car, the Lego car. But then what they do is they sell each of those individual components to the customers separately, and say, okay, you can put the car together however you like, but they've got this whole integrated understanding of how it works in a data center. They call it an AI factory. Like how do we build these AI, like this AI production line, and they understand how it fits together better than anyone else. Maybe an underappreciated source of competitive advantage is NVIDIA's software language, which is called CUDA, which really it allows developers to get the optimum performance from NVIDIA's GPUs. And I think the analogy, for me, a good analogy, is actually Apple. How Apple has created a consumer advantage by integrating hardware and software and get those two elements working together the best. And NVIDIA's done the same with its, obviously, the hardware, and then the CUDA software layer, which then developers build on. So there's something like 5 million developers that are already working in the CUDA language. And so it's kind of like the default. It's like Windows on PC. It's just the language that developers use. And I think it's something like 40,000 companies are building in CUDA. So then what they also do is they build these, so they've got this software layer that you can build on, but then they've got these other software libraries, not just in AI, but it could support like industry verticals. Like there could be a software library if you work in healthcare or industrials or mining. And then they've taken that a step further, and they've got hundreds of AI specific libraries. So you don't have to start from scratch as a developer. You can take these AI libraries, and then you can use that as a starting point and then build from there. And so that creates an extra degree of usefulness and lock-in that is very, very difficult for competitors to replicate. And then the final point, this is not the sum total of all NVIDIA's competitive advantages, but this is an important one, I think, is that fairly recently they changed their product release cycle from the traditional 2 years to 1 year. And so the cadence the sort of speed at which they release new products makes it very, very difficult for competitors to follow them, not only follow them, but to sort of leapfrog them. And so absent a technological miracle or breakthrough, it's going to be very, very difficult for at least GPU competitors to take NVIDIA's lead. So last year, I would, well, for the initial stages of the kind of the AI move, I would say that I was in the more skeptical camp, and that's really a function of there are so many fads that go on in markets that people get excited about that then just fade away. So like, remember Ramaphoria a couple of years ago? You had the European Renaissance, which people got excited about, that Europe was going to become the next US, and those really fizzled. So initially I was skeptical, and I actually put this slide together literally a year ago, and Professor Aswath Damodaran, who's a valuation guru from the Columbia School of Business in New York, he did a DCF exercise and said, look, NVIDIA is the current share price, this was a year ago, is baking in a lot, and there's a path to that in which you can justify this valuation, but it's a pretty narrow path. And so I took that approach. But on the other side, I looked at the forward multiple, I looked at the earnings trajectory and just thought, wow, and I said this in the presentation, like, NVIDIA could even though it looks expensive on a DCF basis, it could still double from here. So I took the view that, I would rather make money than be sort of intellectually correct. And the setup to me was quite interesting. And so we put on a position in the fund, thankfully, and it's worked out, nicely since then. So why have NVIDIA's shares performed so well? And really, it boils down to growth. It's growth in revenue and growth in profit. And you can go to the next slide. So unfortunately, the slide hasn't come through so nicely. But anyway, so revenues, this is just the July quarter last year up to the July quarter this year, never mind sort of before then. But revenues are expected to grow over 100% year on year, while profits are expected to grow over 150% year on year. So just phenomenal growth. And really, just like the last presentation, share prices tend to follow earnings. We can move to the next slide. So yeah, unfortunately, the slide also hasn't come out properly, but so there's a lot of talk comparing, saying, well, it's NVIDIA's a bubble, and let's compare it to Cisco in the late 90s in the tech bubble. So back then there were a lot of companies trading on sort of made up metrics like price to eyeballs or price to clicks. But Cisco, which was the kind of market darling at the time, actually traded on earnings. And it got up to a multiple of 130 times, so 130 PE. So definitely a steamy multiple. But if we move to the next slide, we can see that today NVIDIA is actually trading on a much more reasonable, roughly 30 odd times multiple. Eugene, would you like me to share my slide deck or? Okay, there we go.
No, Dan just fixed it. Thanks,
Okay.
Dan.
All right, thank you. So NVIDIA is trading on a 30 odd times multiple. That's in line with its five-year history. And just to contextualize, if NVIDIA was to get to Cisco's sort of peak valuation multiple, it would have to rise over 300% just to get to that point. So, just in terms of sort of forward PE multiple, it's really difficult to label NVIDIA a bubble today. So what are some bubble indicators that we can have, that we can monitor? And this is something I am doing. Like you want to monitor the valuations of companies like NVIDIA, Broadcom, possibly Arista. You look at the multiples of the tech index, like the NASDAQ. You can follow private market valuations. Not a lot going on there. Market leader, not crazy. Tech index, somewhat expensive, but not ridiculous, not bubble-like. And then the other one is the IPO activity. There's just been nothing happening. It's been really, really dead. I would expect, if you do get a bubble, like people are going to bring AI companies to market like there's no tomorrow. But we're just not seeing it today. And then let's have a look at sentiment, which is quite a fun one, and it's kind of squishier. So in early June, Jensen Huang was at the Computex conference in Taiwan, and he was treated like an absolute rock star. And then the next image, if you go to the next slide, people took, Jensen was signing ladies' chests, and it was just, and people on social media were completely losing their minds about this and saying this is the top right here. And I was a bit, and it actually did precede the top for a couple of weeks later. At the time, I thought, well, will you really get a top when every man and his dog is calling a top? I don't know, but short term, at least, it did mark. It was close to an interim top at least. There we go. And I've just every day on social media. These are just some snapshots from our YouTube feed. You see like calls for broad market crash, end of the world stuff, AI's in a bubble, it's just end of the world stuff. So like if you hear people saying like, oh, everyone's all in, everyone's up to their gills in tech, like there's no doubters, like I don't know, there is plenty of skepticism out in the market. And we can go to the next slide. And I mean, even amongst sort of well-known shops like Goldman Sachs or Sequoia, they are raising questions about return on investment from the people, the hyperscalers spending all this money on AI. And I think they've been burnt in the past, and so and they don't want to look stupid. And so they're raising valid questions, they're raising good questions. I mean, on this point, I think, look, we're only going to know in 10 plus years, and frankly, this question, while a interesting and relevant one, is ultimately irrelevant in terms of whether a bubble will form or not. If the proof is going to happen in 10 plus years, like a bubble can still happen 100% over the next, 2 to 3 years. So I think, and the evidence that's come in from the latest set of quarterly results from the mega caps is they are spending. CapEx is up 30 to 50%. They're spending tens of billions of dollars on AI. And the most important thing is that they can afford it, and they are terrified of missing the next computing paradigm shift, like we saw from mainframe to PC or PC to mobile. And so they are well versed in disruption theory, and they are terrified of missing this next shift, and they can afford it. They can afford to spend. And Mark Zuckerberg has said this, Sundar Pichai has said this, like the risks are of, if we overspend, okay, we overspend, we can still repurpose those GPUs for other use cases within the business. But if we underspend and we're wrong, it could be existential. So we could go out of business. So from a game theory perspective, they're going to spend. Very, very quickly. So what are they going to spend on? One of the things that I think is interesting, sort of short to medium term or medium term, is this idea of agentic AI. So this is them creating an AI agents for you. So I can get my AI bot or agent to go book research and book my holiday. It can pay my taxes. Eventually, we'll get to a point where my AI is going to interact with your AI. It's going to fill our diary, and it'll just be like we could each have 10 personal assistants doing stuff for us all the time. Then longer term, we sort of go into sort of real world use cases like robots and and self-driving cars. much, much, much harder problem to solve and much, much more long term. But the long and short of it is all of these use cases are going to require a massive increase in compute and GPU use cases. And just so the other day, Mark Zuckerberg said that their Llama 4 model, sorry, is going to require 10 times the compute of the older Llama 3 model. So it's just an order of magnitude more compute is going to be needed. So where are we in the sort of potential AI bubble kind of phase at the moment? So turning back to George Soros, applying his framework from the alchemy of finance, and it's in the next slide, is, there's two lines. There's stock price and the earnings. And as I've shown with, with NVIDIA, it hasn't re-rated. And it's all been an earnings story. So I think we've had a correction in the AI names. So I've circled it with the green bubble there. I think we're potentially kind of early days in this. I think the AI story is going through a test. I think a lot of people are giving up on it, saying, oh, it was overhyped. Maybe it was overhyped kind of short term, but I think there's potentially more to come. And I think we could be getting into the really, really interesting part where, after a period of digestion, maybe a couple of months, I think the stocks are potentially ready to go again. And just to conclude, so my take is, look, I don't think AI is in a bubble today. I think there's a reasonable chance that an AI bubble sort of does develop as we see, more use cases in real life. So I think one could develop over the next, 18 months to 3 years. If that's the case, then, as George Soros said, like, I think it makes sense to participate, but you've got to manage risk and be aware of the game that you're playing. With that in mind, the NVIDIA's, this was at the end of last month. It was the fund's largest holding. As of today, it's the second largest holding, and it's really got through performance. And then looking out ahead over the next couple of months, I would be keen to kind of add to the space as long as I'm seeing the right signs. I would say both fundamentally and technically. If it's early days, then there's still plenty of opportunity in this space. And with that, I would say thank you for your time. Thanks, Eugene.
Nick, thank you so much for that. Very insightful indeed. Very important, this whole AI discussion. And I think you concluded very well. Don't blink. There's definitely more to come in AI. Looking forward to it. And we can find a lot of that in your global equity mandate. You've got an AI fund as well. So thank you for that. Apologies for the gremlins in the presentation, but I see Dan fixed it very quickly. But all is well that ends well. Nick, thank you so much for your time today. We're always grateful. We're going to end it there. And thank you to our audience for allowing for a little bit more time. We did steal some of your time today, but I think it was insightful indeed. And thank you for joining us and your continued support. Always great to have you with us. Today, our presenters presented on several ways how to find value in opportunities across the globe, but it's all about the excellence and experience they bring as top quality fund managers to add value to your client portfolios. To the BCI team, Tanya, Olga, thank you so much for making all these sessions possible. Dan, thank you so much for driving all the sessions. It's always great. We're looking forward to seeing you again next week, Wednesday, the 21st of August. We will continue with our offshore managers, being joined with the likes of Lindsell Train, Fundsmith, T. Rowe Price, Sands Capital, and Gings Global. Looking forward to next week. Enjoy the rest of your week and may you have great success. We'll chat next week, Wednesday, and keep well. Thank you.